Hello, I'm John Kreitler. Welcome to This Week in the Markets. On Wednesday, the Federal Reserve kept the federal funds rate at a range of 5.25 to 5.5%. In its written statement, as well as during the press conference for Chair Powell, they talked about the 2% inflation mandate being their goal. They'll be data dependent. The interesting thing was that the summary of economic projections, the dot plots, last released in June, was released again with this meeting. 12 out of 19 committee members still see one more rate hike as being necessary this year. They also look at a stronger economy, lower unemployment than previously thought. They also look at 2 out of the 4 rate cuts that they talked about in the second half of next year being removed, in essence, higher for longer, with a federal funds rate for most of 2024 above 5%. In response to this, the bond market broke through its 2007 highs, the 2-year over 5.1% and the 10-year at 4.4%, still inverted, but at the high end of its range now being broken. For its part, the stock market indexes, again going through its August and September market correction, stayed below its 50-day moving average, pulling back, especially the big cap tech and the longer duration, more expensive stocks. One thing I'm looking at is global currencies, specifically the Japanese to US dollar and the Chinese yuan to the US dollar. Many times global currency pairs are a safety valve, trying to get an equilibrium in the financial markets based off interest rate differentials between countries and balance of trade. Next week brings the end of the third quarter with some window dressing for the financial markets, as well as the GDP report. Thank you again for watching This Week in the Markets. I'm John Kreitler. Have a great week.